Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into Firefly Aerospace Inc., FLY.
This is a fascinating one. A company at a real crossroads.
Absolutely. So let's lay out the thesis right at the top.
Okay.
Firefly Aerospace is currently betting its $995 million post-IPO cash hoard and massive $1.3 billion backlog on a successful transition from being a pure-play developer to becoming an integrated defense logistics and services provider.
And that second part is key. This pivot relies heavily on leveraging the recent $855 million SciTec acquisition to accelerate diversified growth and, crucially, to help overcome the long-standing hurdle of a $979 million accumulated deficit recorded as of September 30, 2025.
That is a powerful statement of conflict. I mean, you have a company that has, on one hand, solved its immediate, almost existential capital crisis, but they've only done it by taking on an enormous amount of new strategic and, integration risk.
Exactly. Historically, Firefly was defined by two things: heavy R&D spending and significant debt financing to pay for it. The whole story now is whether that dramatic financial shift we saw in the third quarter of 2025 was enough to really, truly change their trajectory for the long term.
So let's unpack that financial transformation first, because that IPO in August 2025 was, you used the word seismic. It really was.
It was. This wasn't just about going public to get some cash. It was a total aggressive overhaul of their financial structure.
Yeah.
It was designed to, wipe the slate clean.
And they sold a lot of stock to do it.
Oh, yeah. An aggregate of 22.2 million shares. And that number includes the underwriters exercising their over-allotment option in full. So maximum possible fundraising.
And the impact on their liquidity, on the cash they had on hand, was just instant.
Instant and profound. The net proceeds from that IPO event totaled, $932.3 million. And then, when you look at the balance sheet just a few weeks later, as of September 30, 2025, Firefly reported an astonishing amount of liquid capital, $995.2 million in cash and cash equivalents.
So just shy of $1 billion in the bank. For a company that was, like you said, recently in pretty serious debt distress, that completely de-risks their near-term operations.
It does. And it gives them incredible optionality.
It's that optionality that really matters most, right? That capital didn't just sit in the bank. It was immediately put to work fixing the balance sheet.
Immediately. They used a substantial portion of those proceeds to fully repay the term loans they had under their prior financing agreement. That amounted to $136.1 million in principal outstanding at the end of 2024.
And getting that off the books was a critical step.
It was a necessary step. It was the only way to remove the restrictive covenants and the high-interest burdens that come with that kind of high-yield private debt.
But that repayment, paying it off ahead of schedule, that came at a cost, didn't it? It wasn't free to just clean up that debt.
No, it wasn't. The early repayment triggered fees, which contributed to a pretty substantial non-operational $30.4 million loss on extinguishment of debt. That was recorded in Q3 2025.
Okay, so that's one of those things that looks bad on the income statement, but is actually a good strategic move.
It's a classic example of paying a short-term penalty for long-term structural health.
Yeah.
And the result, the balance sheet rehabilitation, is the real headline here. They transitioned from a prior debt-heavy structure, which included a crushing accumulated deficit of $767.6 million.
As of the end of 2024.
Right. From that to reporting total stockholders' equity of $948.8 million as of September 30, 2025.
They completely flipped the script.
Completely. Moving from a negative net worth, which is a really dangerous place to be, to having a robust equity cushion of nearly $1 billion.
This leads us right to that Q3 2025 net loss. It was $133.4 million. When we see a number like that, a triple-digit million-dollar loss right after a huge IPO, it's easy for people to, panic.
Of course.
But we need to look at that loss through this lens of financial restructuring. How much of that was them actually losing money on operations versus these one-time non-cash charges?
And that's where the detailed analysis really starts. That $133.4 million net loss is really a collection of charges. Many of them are non-recurring. And importantly, non-cash.
We already talked about the $30.4 million loss on the debt extinguishment. That's a strategic one-time payment.
Exactly. But there was an even larger and more complex non-cash charge. It was related to the change in fair value of their warrant liability.
Okay.
That clocked in at a massive $47.2 million for the 9 months, ended September 30, 2025.
Wait, let's pause there for a second and explain warrant liability, because this is technical finance jargon that can confuse even savvy listeners. Why is there a $47 million non-cash charge here? And why does it hit the books right at the IPO?
That's a great question, and it speaks directly to that shift from being a private company to a public one.
Yeah.
So when Firefly was private, they issued financial instruments called warrants.
Which are basically options, right? The right to buy stock later at a set price.
Precisely. They were issued as part of their earlier financing deals. Since the stock wasn't publicly traded, accounting rules say you have to mark these warrants as a liability on the balance sheet, and their value constantly fluctuates based on complex models of the company's perceived value.
Okay, so it's a paper liability.
A paper liability. Then the IPO happens, and suddenly the market knows the real price of the stock. That $47.2 million charge represents the sudden increase in the fair value of those outstanding warrants, because now they were convertible into high-value public shares. It's a pure accounting adjustment. It's non-cash, but it makes the loss look dramatically worse than the actual operational cash burn.
So if we add that up, you've got $30 million from the debt cleanup and $47 million from the warrant revaluation. That's nearly $80 million of that $133 million quarterly loss that is purely restructuring costs and technical accounting adjustments.
Exactly, and we still haven't even factored in the substantial one-time transaction costs that are just part of doing an IPO.
Right, the legal fees, the banking fees.
All of it. Their selling, general, and administrative expenses, or SG&A, increased sharply. That was driven primarily by about $7.4 million in professional fees and stock-based compensation, all tied to the IPO execution.
So when you properly deconstruct it, when you strip out all these non-recurring items, the debt payoff, the huge warrant revaluation, the IPO expenses, the operational picture starts to look much, much cleaner.
It does. And management, they rightly focus on operational metrics and non-GAAP figures like adjusted EBITDA to give you a truer sense of the underlying business trajectory. The operational focus going forward is clearly on aggressive growth, supported by this enormous cash cushion.
And now they have access to more traditional, cheaper debt, too.
Right. They backed it up by securing a new $125 million revolving credit facility right after the IPO. So they have liquidity, they have flexibility, and they've cleaned up all their prior debt problems.
Okay. So the capital problem is solved. Now we have to talk about how Firefly translates that capital into a sustained valuation. And that depends entirely on their operational successes, the ones that build a true competitive moat. And in 2025, that moat is being forged on the moon.
It absolutely is. Firefly achieved an operational milestone that you just cannot overstate. They are the only commercial company to achieve a fully successful moon landing with their Blue Ghost Mission 1, or BGM-1.
This isn't just a participation trophy for getting there. This means they've matured their entire spacecraft solutions division and successfully navigated the incredible technical complexity of NASA's Commercial Lunar Payload Services program, the CLPS program.
And success here is defined by meeting really rigorous metrics, not just, as you said, sticking the landing. They completed all 17 predefined mission objectives.
All 17?
All 17. This included deploying and operating multiple NASA and commercial payloads, performing complex maneuvering on the lunar surface, and achieving long-term power generation and communication. It was a complete mission success from start to finish.
And they didn't just land and shut down. They set a new commercial standard for how long a mission can last up there.
They did. BGM-1 achieved the commercial record for the longest operational period on the lunar surface. And in that time, it provided a phenomenal 120 gigabytes of data back to Earth. This operational success is key because it establishes reliability and capability in a highly visible, very high-stakes domain where very few competitors have succeeded.
And we can see the financial returns on that specific operational success already accelerating their revenue. The Q3 2025 financials show that their spacecraft solutions revenue grew by a staggering 134% year over year.
Right, and a significant portion of that growth was the direct monetization of the mission data itself.
That data part is where the long-term, high-margin, scalable revenue stream is, and it's critical for you as an investor to understand this mechanism.
It is. They executed a $10 million NASA contract addendum for BGM-1. This wasn't for more hardware or launch services. It was specifically for the provision of additional science and operational data that the lander collected. This highlights a crucial, very high-margin data licensing revenue stream that they market as their Ocula service.
Let's dwell on Ocula for a moment. Most space companies make their money on fixed-price launch contracts, which are high risk, high cost, and often the margins get squeezed by competitive pricing. The Ocula service, based on proprietary data from a successful mission, that's fundamentally different.
It's a totally different business model. It's an annuity stream. It's a high-margin data licensing business where you're selling the same asset, the data, to multiple customers. That could be NASA, it could be research institutions, or other commercial entities who are interested in lunar geology or radiation readings.
So once the mission is paid for and successful, every dollar from data sales is almost pure profit margin.
It adds an element of passive, scalable income to a business that's traditionally been dependent on building expensive, high-risk physical products. If they can continue to successfully land on the moon, they are essentially generating a new line of high-quality data products that just keeps paying for years.
But while that data stream is really exciting for the future, the backbone of their long-term visibility, the sheer amount of contracted revenue, is still that total contract backlog.
Yeah. And that backlog is currently sitting at approximately $1.3 billion as of September 30, 2025.
A $1.3 billion backlog gives a company tremendous confidence. It gives you visibility for half a decade. And the source of that backlog is highly concentrated in these lucrative NASA CLPS missions.
Right. The backlog includes 4 CLPS missions in total. That's the Commercial Lunar Payload Services Program. And those alone represent over $500 million in contracts.
And these are not trivial missions. They are foundational to NASA's whole Artemis program.
Absolutely. Blue Ghost Mission 4, for instance, was just awarded recently, and it's slated for a landing at the critical moon's South Pole region in 2029. That provides revenue visibility not just for next year, but stretching 5 years into the future. That is invaluable stability in the volatile space industry.
And maybe the most crucial financial advantage that's tied to this CLPS work is the contract structure itself. It significantly de-risks the whole production process.
It does. Their contracts are milestone-based, which means the company typically collects approximately 90% of the total contract value before the launch actually occurs.
That's a game changer for working capital management. I mean, think about that. They are essentially building their multi-million-dollar spacecraft using their customers' cash flow.
They don't have to carry the majority of the manufacturing costs internally for years, and that reduces the pressure on that $995 million post-IPO cash hoard. They're financially insulated throughout the production ramp compared to competitors who might have to fund significant R&D and manufacturing internally, increasing their debt or relying on dilutive equity financing.
Okay, so the financial house is rebuilt, the lunar moat is established. This brings us to the next massive strategic gamble, the one enabled by all that IPO cash, the acquisition of SciTec. This move signals a deliberate, sharp turn away from their original identity.
The SciTec acquisition, which closed on October 31st, 2025, is the definitive proof that Firefly is no longer content just being a rocket manufacturer. It's a strategic pivot. They're moving toward becoming a diversified, integrated defense and logistics provider.
And the purchase price was steep.
Very steep, $855.6 million. They funded this using a combination of their new liquidity and stock. $300 million in cash, which was a direct application of those IPO proceeds, and just over 11 million shares of common stock.
The rationale here seems clear. This acquisition transforms Firefly into a full-service hardware and software provider.
That's it exactly. They are vertically integrating beyond the physical launch vehicle and the lander and extending into the high-margin data processing and services layer. That's where the future of national security space is headed.
And SciTec brings an incredibly high-value, sticky client base and a very specific expertise in the defense sector.
Right. They're not just a generic software company. They specialize in defense software analytics, remote sensing, and a term we need to explain: multi-phenomenology data expertise.
What exactly does multi-phenomenology data expertise mean, and why is that so valuable to the Defense Department right now?
It sounds esoteric, but it's essentially the ability to rapidly fuse and analyze massive data sets coming from fundamentally different types of sensors. That's the multi-phenomenology part.
Okay, so like combining visual, infrared, and radar data all at once.
Exactly. Imagine a single intelligence picture where you are simultaneously integrating visible light imagery, infrared heat signatures from a missile launch, radar tracking data, and electronic intelligence signals. SciTec has the software backbone to ingest, filter, and process this incredibly complex high-velocity stream of data. And this is the crucial part. Used AI-enabled systems to generate immediate, actionable intelligence.
And that capability is essential for critical national security sectors, particularly missile warning and ISR intelligence, surveillance, and reconnaissance.
It is. The Defense Department is moving toward these resilient, distributed constellations of satellites. Those constellations are going to generate unimaginable quantities of data. If you can't process it rapidly on the ground or even in orbit, the hardware is useless.
So SciTec provides the essential intellectual property that closes the loop between Firefly's hardware, like launching the sensors, and the end customer's need, which is actionable intelligence.
Precisely. And this isn't just a promise of future work. SciTec brings strong, immediate contract visibility that validates its value. This includes a previously awarded large $259 million Space Force Forge contract.
Forge deal. That stands for the Future Operational Resilient Ground Evolution Framework.
Right. And the Forge contract is a critical framework within the Space Force for building out the next generation of resilient ground systems. It's part of a larger government-wide effort, sometimes called the Golden Dome Defense Initiative, which is all about rapidly modernizing and integrating space-based assets with ground infrastructure.
So by acquiring SciTec, Firefly instantly steps into the role of a prime contractor that can handle these complex logistics packages. They are now playing in a much bigger sandbox than pure launch providers.
The whole narrative shifts.
Yeah.
It's no longer about selling a single product, a rocket, to the government. It's about selling the end-to-end, high-margin, sticky software and data services that utilize the hardware they manufacture.
It's a vertically integrated solution, and they're aiming for higher margins and recurring revenue streams inside the defense industrial base.
Exactly.
But this strategic shift, as brilliant as it sounds on paper, is also the source of the greatest future risk. Management was very explicit about the potential pitfalls of absorbing a company this big and this complex. We have to address the integration risks.
This is the crucial caveat. This determines whether the investment thesis is a home run or if it becomes a value trap. Management explicitly stated that the future success of this new direction hinges on successful, seamless integration.
And the complexity is immense. You're merging a manufacturing rocketry culture with a high-speed, classified defense software development culture.
Two very different worlds. Potential difficulties include integrating and harmonizing incompatible technologies, finding that the costs of integration are way higher than you originally estimated, or, and this is the most critical one in software and defense,
The loss of key people.
the loss of key employees. If those key software developers, those engineers, those cleared personnel from SciTec decide to leave, the value proposition of that $855 million acquisition immediately starts to crumble.
And if the anticipated sales synergies and growth opportunities, especially winning those bigger defense logistics contracts, if they aren't fully realized, it could severely affect Firefly's financial condition and indefinitely delay their path to profitability.
It's a very complex corporate maneuver,
Yeah.
and they're executing it under the pressure of simultaneously scaling up their launch operations.
That tension between the need for a stable, successful financial integration and the inherent volatility of hardware development, that is the core of the investment risk here. So let's switch back to the hardware side of the equation and focus on the technical edge Firefly brings, specifically with the Alpha rocket.
Right. Alpha's competitive differentiator is highly specialized. Responsiveness.
The defining feature of Alpha is its engineered capability for rapid tactical responsiveness, which speaks directly to defense needs.
It does. The Alpha holds the industry record for a 24-hour tactically responsive launch, which they executed during the Victus Nox mission for the Space Force. They were told the payload, the orbit, and the time, and they launched within 24 hours. This fundamentally changes the logistics planning for national security missions. It shatters the previous industry standard, which often required weeks of prep.
And the engineering secret sauce that enables that speed is a really clever trade-off they made with propellant management.
It is. Many competitors chase maximum performance by using supercooled propellants, like liquid oxygen or LOX, at extremely low temperatures to get maximum density. Firefly, however, opts for a system that uses warmer LOX.
It's a deliberate design choice. They're sacrificing a little bit of thrust performance. A denser propellant gives you a slight edge in payload capacity in exchange for enormous operational flexibility and speed.
Exactly. Because the propellants are warmer, it allows the tanks to be continually topped off as the liquid evaporates, but without losing performance. This dramatically elongates the launch window.
So if there's a weather hold or a minor technical glitch, the launch doesn't have to be scrubbed for the day, which involves the complex and expensive process of draining and reloading cryogenic fuels.
They can just hold, top off, and proceed hours later. This operational availability is arguably more valuable to the Space Force than carrying an extra 100 pounds of payload.
That philosophy engineering for robust availability and speed rather than just optimizing for peak theoretical performance, that's what the Department of Defense is paying a premium for. And they aren't just confining this technology to Alpha, they're scaling it up dramatically.
Indeed. The core technology that was established in Alpha, including their proprietary carbon composite structures and the Reaver engine design, is being leveraged for their much larger reusable vehicle, the Eclipse rocket.
And Eclipse is designed to carry 16 tons to orbit, which moves them squarely into the highly competitive medium lift class.
It does. And this is where the long-term vision and some important external validation come in. The development for Eclipse is being supported by a significant $50 million investment from Northrop Grumman.
That investment strategically aligns Firefly with the most important government program in the sector, the National Security Space Launch, or NSSL, Lane 1 program.
And NSSL is the pathway for the U.S. military's most critical, highest-value missions. Getting a foothold in that program with Eclipse, which is anticipated for its first launch in late 2026, is essential for capturing that larger, long-term launch market.
But we have to maintain a balanced view. The space industry is inherently brutal, and development setbacks are not just possible, they're common. We have to address the recent operational risks, specifically the Alpha Flight 7 ground test loss.
That event was a very real, very public setback, even if it was just a ground test. The loss of the vehicle during the Flight 7 ground test was attributed to a process error, specifically hydrocarbon contamination in the system.
It just speaks to the inherent difficulty of developing rockets. A tiny error in a valve or a cleaning procedure can lead to a catastrophic failure.
It can. However, the speed and effectiveness of their response is the crucial takeaway for an investor. That vertical integration model allowed for immediate and decisive corrective actions.
So they were able to figure out what went wrong and fix it quickly.
Very quickly. They had to implement changes rapidly, including increasing the thickness of the thermal protection system on the first stage, and also adjusting the flight profile to reduce the angle of attack during critical phases of ascent. This rapid iteration, driven by immediate access to engineering and manufacturing, demonstrates their ability to learn and correct faster than peers who rely heavily on external supply chains.
And that speed is directly enabled by their unique operational footprint. Their 3 core facilities, the corporate headquarters, the Hive spacecraft facility, and the Rocket Ranch manufacturing and testing site, are all co-located within about 25 miles of each other in Texas.
That proximity is not a minor detail. It's a huge competitive advantage that directly influences cost and time to market. When you have engineering, manufacturing, and testing all co-located, you eliminate the massive friction and delay caused by shipping components across state lines or communicating across organizational silos.
There's a powerful anecdote that backs this up, right? From the Victus Nox mission.
Yes, and it speaks to the high-stakes drama in this industry. Leading up to that critical Victus Nox mission, a vendor-supplied component failed. This was a disaster that could have completely derailed the 24-hour launch record.
And normally that would mean months of delay.
Instead of facing an 8-month delay waiting for a replacement from the vendor, Firefly engineers working around the clock were able to design, qualify, and build a fully functional replacement component internally in just 41 days.
Wow. 41 days.
That level of internal control and responsiveness is perhaps the greatest validation of their vertically integrated model, and it directly translates into customer trust and retention.
Okay, so let's synthesize the current state before we get to the final verdict. We have nearly $1 billion in cash, a confirmed lunar competitive moat, a massive $1.3 billion backlog with superior payment terms,
A crucial defense software acquisition in SciTec.
and a technologically advanced responsive rocket program with Alpha and the upcoming Eclipse.
But we have to return to the financial history. Despite solving the near-term liquidity issue, that historical burden of massive R&D spending and operational losses still weighs heavily on the company's financial health. The $979.2 million accumulated deficit remains a substantial and very real barrier to achieving long-term profitability. That is the financial hole they still have to climb out of.
And the depth of that hole reflects the ongoing, intense requirement for heavy, continued investment in the Eclipse program and future technology. We can actually quantify this intensity, which is crucial for you to gauge the operational expense here.
Absolutely. If you look at their research and development intensity, that's the amount spent on R&D relative to the revenue they generate, it is extremely high. It's coming in at 114% PTM, or trailing 12 months, when compared against trailing 12 months revenue.
114%. So for every dollar of revenue they brought in over the last year, they spent $1.14 on R&D.
Exactly. To put that in perspective, many established aerospace and defense companies operate with R&D intensities far below 10%. Even high-growth tech firms rarely sustain R&D intensities above 50% for very long. Firefly's 114% reflects the massive ongoing capital burn required to simultaneously develop the Eclipse rocket, scale alpha production, and integrate all the new software capabilities from SciTec.
For you as an investor, this 114% R&D intensity means your entire investment thesis rests on their ability to manage this capital burn rate effectively, to hit milestones and convert that expenditure into future profitable revenue faster than the company depletes its IPO cash.
That's the race.
This brings us to the final verdict. We have to synthesize whether these extraordinary strategic moves justify the valuation and the substantial risk profile. The bull case has never been clearer, but it is entirely predicated on execution.
The bull case rests on three interconnected pillars. First, they dramatically solved their capital constraint, moving to nearly $1 billion in cash. Second, they have substantial, high-quality prepaid revenue visibility backed by that $1.3 billion backlog and the superior working capital structure from those milestone payments.
And third, the SciTec acquisition.
Third, the SciTec acquisition is a mandatory evolution. It moves them into higher-margin defense logistics, combining proprietary responsive hardware Alpha and Blue Ghost with advanced software, the AI-enabled ISR, to create a compelling end-to-end provider for the national security sector.
However, the risk profile is defined by that high development intensity and the complexity of the integration. The reliance on heavy, continued investment is reflected in that 114% TTM R&D intensity. And while the backlog is large, it remains just that, a backlog.
So the core challenge for Firefly is strictly cash conversion. Can the $1.3 billion backlog and the benefits from the SciTec integration be realized and converted into meaningful free cash flow and drive sustained profitability faster than the company burns capital on R&D and scaling programs like Eclipse?
Because if they fail to execute the launch cadence, or if the complexity of merging a manufacturing company with a defense software firm proves too difficult, that presents a recognized and material threat to their long-term viability, despite all the cash from the IPO.
The investment rests entirely on their ability to successfully integrate SciTec while simultaneously ramping the alpha cadence and bringing the reusable Eclipse online to meet those critical NSSL requirements.
That leaves us with a provocative thought, and it's built on one of the most unique revenue streams we uncovered today, that high-margin, scalable annuity from Lunar data. We've talked extensively about the need to convert launch and defense contracts into profit.
Right, and we noted that the successful BGM-1 mission resulted in that high-margin $10 million NASA addendum for the Ocula data licensing service. The company owns that data. They have the ability to sell commercial licenses for scientific or operational research to multiple customers all over the world.
So the question for the long term isn't just about launching more rockets, it's about the scalable efficiency of their services.
Exactly. Will the high-margin, scalable annuity revenue from data licensing, leveraging missions they've already flown and paid for, prove to be the most crucial, durable component of achieving sustained profitability? Or will the intensely competitive pressures of the core launch and defense hardware contracts continue to dominate and depress the overall margins? The future profitability might hinge not on the physical delivery of hardware, but on the intellectual property generated during the mission.
Risk defined, portfolio protected.